Well, the banking sector turmoil is putting the Fed in a bind as the fallout of Silicon Valley Bank continues with its parent company SVB Financial filing for Chapter 11 bankruptcy protection. Now, here to discuss all this and more is Samantha LaDuc, LaDuc Trading founder. Good to see you, Samantha. So the question on everybody's mind, because of course, we thought we were in relatively good shape with investors yesterday. A different story today. Is the bank run over?
It's definitely the biggest question on many people's mind. Is the bank run over, and do we have a credible backstop? I think short term, yes. We've had the promise, if you will, Fed, Treasury, White House Sunday evening, and that has slowed the fear and the contagion. But longer term, no. I think it's pretty clear that this is a symptom of this commingling of fiscal and monetary, the commingling of Treasury and Fed that is actually very undermining to financial stability. So they did step in to stem the deposit outflows and to backstop literally. It's not QE, but it's definitely kind of the promise or the implicit QE, and the monetary framework is very loose with that. So tech loves it, Bitcoin loves it, gold loves looser monetary policy. So it's a little confusing because we are having this kind of melt up in the momentum space, but bigger picture, it is not sustainable long term.
So then as we look at the implications for this emergency lending program and what we're seeing with the Fed's balance sheet as well, how should investors be positioning themselves then, given that there still is this outstanding risk?
The risk is basically going to be whack-a-mole, right? So they're going to have areas of more disruption, if you will, in the unrealized losses that come to bear when a bank or insurance company or other needs to recognize it. Another financial institution needs to recognize it. So it's really the promise of unlimited backstops. That's not sustainable. So right now, banks didn't take so much of the facility that was offered, the BTFP, and they definitely have stemmed this confidence crisis in the immediate crisis. But it does not negate the fact that it's unsustainable U.S. government debt. And right now, the market very much trades inversely with this flow of backstopping, and tech and semis and gold obviously are smelling that loose monetary policy. But there is now the question, all eyes on the Fed. I really think that this is going to be very tough for them. They're trapped. Fed is trapped, if you will. They can't raise too aggressively. Luckily, inflation is decelerating month over month since its peak in June at 9.1. It's now CPI came in at 6%, but it's still too warm. The economy is still too warm. A lot of the lagging impulse from these higher rates hasn't really been felt yet in the economy. So that is putting them in a tough spot. Can't pause or pivot. Can't hike more aggressively. It looks very much like the short end of the rates are done going up. And there has been a lot of FOMO to basically capture that yield in those short duration T-bills, because they have reversed very strongly lower. And I think that's going to continue. The short end is actually going to continue to fall. So as it relates to advice that I gave my clients even before this bank failure, not just confidence, but pricing, was very much a deflation impulse. So my recommendation was the past month, to short reflation trades, which happened to be banks before knowing that there was going to be a crisis, as well as metals and mining and energy. And we've had a strong pullback in energy, oil and gas companies of late, but especially crude. Down to my $65 price target. So I think that that's more of an implication of deflation of assets, even though tech is acting like a bond proxy right now and rising very sharply with gold in light of this loosened monetary policy to try and backstop the bank run.
And I mean, this really does open the door on this conversation about moral hazard. We saw that Senator James Lankford went back and forth with U.S. Treasury Secretary Janet Yellen, and that was part of her testimony this week. Take a listen. I want to get your reaction.
Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVB just got or Signature Bank just got?
a bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk.
Now, there is the potential for sort of moving goalposts here. I want to get your take. What's your reaction to that?
I think the Silicon Valley Bank failure is very much a testimony to failed monetary policy, in that the risk-free the risk-free assets adopted by these financial institutions, both, by the way, here and abroad, is this quasi-deficit financing of U.S. government debt. And it's a mismatch. So this duration risk mismatch, it's fine until it has to be recorded. For example, in the case of Silicon Valley Bank, where they then had to realize those losses. And that's what threatens financial stability. That's not done. That problem is huge. So this is the risk to both equity and bondholders that forced the Fed's hand in the first place to backstop with their implicit pivot. So it's an implicit Fed pivot, but we're not at a point of an actual pivot, because that would, the economy is still running, strong enough to sustain maybe one more 25 basis point rate hike in the next FOMC meetings next week. But I still think that this is a quintessential case of Fed is trapped. So hike too high, things start to break. We've already seen that happen. And that's first banks and then credit lending. Then it translates into consumer jobs and spending. So hike too little and inflation, expectations move higher. So I think right now this is an implicit Fed pivot, and the market is smelling that, hence why gold is higher, bonds as well with tech. I think the equity market, however, will start to pull forward that recession risk that this causes, and we're not out of, this is not risk-free anymore.
Certainly hard for the Fed to be both the problem and the solution at the same time. Samantha LaDuc there, thank you so much for joining me this morning.